Have you ever wondered why you have to take more risk to get more return on investment? What if that weren't true? Well, if you want to find out, stay tuned this week's episode of the Retirement Income Source, where it's all about the income. And welcome this week's episode of the Retirement Income Source, where it's all about the income. I'm David Scranton, of course, here with my good friend and co-host, Sarah Samuels. And we've got a great show put together for you here on this Easter season, where we're going to dispel a lot of the myths that you hear about retirement income and how to generate retirement income. Myths that I would go on a limb and say probably 4 out of 5 financial advisors fall into these traps. And yes, one of those is going to be that you might just not have to take more risk to get more return. So what do you think about that, Sarah? Do you think we might blow some minds here on this Easter season?
Well, Dave, I think it almost sounds too good to be true, but I know that's not the case with our show.
Not the case. And here's the thing. Easter is all about the fact that Jesus blew people's minds, right?
That's right.
Rising from the dead with all the Roman soldiers around the tomb. How did he do this? It was a miracle, right?
That's right, yes.
So to a
Easter
much
miracle.
lesser scale, I want to show what I believe is a miracle when it comes to retirement income investing today. But first and foremost, this last weekend was really nice. I got to spend some time with our financial advisors, a lot of them around the country. We're down the house in Marathon, and we got the last 11 lobsters of lobster season. But I wanted to know, when you catch lobster, how do you do it? Just tell me a little about your technique.
Right. Well, for all of our listeners and our viewers out there that aren't in Florida or aren't familiar with lobster fishing, you have a couple tools. You have something called a tickler and a net, and you dive down there. You look for the little antenna popping out of the rocks typically, and then use the tickler. You kind of push the lobster. They'll fly out of there, and you grab them right in the net. It's good eating.
Okay.
So tell me, how did you guys catch the lobster down there, Dave?
Well, I got the last 11 of the season with my Visa card. Actually, it was a pretty neat trick, to tell you the truth.
Okay, yeah, tell me.
Yeah, I went into, as I dove, I took the Visa card and I scraped it against the rock, and it makes a really annoying noise,
Right.
and the lobster comes flying out and you catch it.
So you dove right into the supermarket and got those
That's
last
right.
11
Right,
lobsters.
right in the fish market. A lovely lady down in Marathon by the name of Dee said these are the last 11. So we were able to get them for all the guys. It was pretty cool. But,
Wow.
But your way sounds more fun.
Yeah,
anyway.
well, Dave, I'm so glad you guys got to spend time down there in the Keys and being out in nature and enjoying each other's company. And that's part of the reason why a lot of people look forward to retirement. They're looking forward to having that time off to enjoy time with family.
Sure.
So there's got to be a purpose, really, when you enter retirement, right? You've got to have a goal and you've got to have a purpose for your money.
Right, and you have to ask yourself, what if, for most of our listeners right now, if they are planning for retirement, they're on the home stretch within 10 years of retirement or maybe retired, you have to say, well, what are they going to do with the majority of their retirement funds, right? Are a majority of the funds going to be used to make a lump sum purchase, maybe a second or third home? Or are a majority of their funds really not going to be touched during their lifetime? It's really just there to leave a big legacy, leave a lot of money for others. Or are a majority of their funds there to generate retirement income? If I gave you those 3 choices, what would you guess? If you could mind read our listeners, what would you guess a majority of them would say?
Well, my educated guess would be that most of them would say they want the income, Dave. They need that income in retirement to pay for things.
They want the income. And we talk about that all the time on the show. And you might say, oh, ho-hum, that's great. Yeah, okay, so it's all about maximizing income. But as you'll see later on the show, it's a lot more than that. And frankly, it's a big part of the secret as to how you might just be able to get more return without taking more risk.
Perfect. Well, speaking of risks, we've got our Ask Dave question. This one comes from Rachel in Minnesota, and she says, the only thing I know for sure in life is death and taxes, right? So aren't most things uncertain in the financial market?
Well, they are. There are, but there are things that are less uncertain. Nothing's 100% certain. We even just the news last few weeks questioning even the safety of banks, right? If you're over the FDIC limit, are you even going to get bailed out, right? Who knows? So nothing is that certain, but if you were to take a risk scale of 1 to 10 and bank CDs are a 0 and the stock market's a 10, there are things that you can do that might be a 1 or a 2 or a 3 that are much more certain, where the outcome, the return on investment is much more certain. And some of those things Rachel will be talking about on today's show. So I hope you can stay with us for the rest of the show, because this whole show is going to be essentially an answer to your question.
That's right. We're going to be dispelling all of the myths out there and clarifying some retirement income fallacies for you all. So, Rachel, thank you so much for sending in your question.
Great
and if
question.
anyone out there wants to send in a question for Dave to answer, just send us an email at askdave@retirementincomesource, SOURCE.com. And thank you for spending your listening here with us on the Retirement Income Source. I'm Sarah Samuels. I'm here with Dave Scranton. Today, we're talking about retirement income myths. We're clarifying some of these myths. And Dave is really going to share the secret, too, with the reason as to why you don't need to take more risk to get more return.
Yeah, in fact, I think where Rachel's question really came from was the fact that, and I'm going to pose it as a question, right? If we were to take a survey of our audience and ask them a simple question, gee, do you want to build a retirement plan based upon what you hope is true, or do you want to build a retirement plan upon what you know is likely to be true? Which do you think they'd answer?
I think I'd go with what I know is likely to be true, not what I'm hoping and praying is true.
That's right, and that's where Rachel's headed with this. That's what she'd like to do, I would guess, but doesn't know that it's possible, and it is. So let's first of all, let's talk about the stock market, right? Stocks can go up and down. You can have growth or you can have loss.
Right, and there could be a lot of risk associated with the stock market.
That's right, but you can also have dividends, right? So which is more dependable, the dividend or whether things are going to go up or down in value?
Well, the dividend, of course, because it's almost guaranteed, essentially guaranteed.
That's right. So we say, you have to ask yourself, what is the purpose of your money? If the purpose is maximum return with minimum risk, right, which is what everybody really wants, but for future income, because most of that retirement money is going to be used for income, then if you're going to be in the stock market, you have to invest for dividends, because that's all that you know. See, if I'm investing in the stock market for growth, low or no dividend stock strategy, right, I can't tell you with any certainty 10 years from now how much money you're going to have. It could be more, it could be less, it could be the same. We don't know. But let's say, hypothetically, you had a 4% dividend, right? And you have $1 million. Well, what I know is that you're getting $40,000 a year of dividends. And I know that companies dividends are sticky. Companies don't like to cut their dividends. Sometimes they have to, but they don't like to. So if you have a diversified portfolio of good securities, then hopefully that $40,000 will be sticky. But I also know that if you reinvest that $40,000 each year, that it'll grow by 4%, right? So that means 10 years from now, you're going to have closer to $60,000, okay? That's what I know. But if you ask me how much income you can get 10 years from now with a zero dividend strategy, I don't have a clue, because it all depends upon what your lump sum is going to be worth. Make sense?
No, that makes sense, Dave. And it makes sense why people would need to invest the dividends because of all those things you just mentioned. So what kind of stocks out there do provide dividends?
Well, a lot of stocks do. And I want to talk, I think later on the show, we need to talk a whole section about, how to do that, because this isn't a, set it and forget it or try it at home type thing. You have to know what you're doing. But the point is that some stocks pay higher dividends than others. And if you're going with the no dividend strategy, well, then you're playing Russian roulette. If you're going with a higher dividend strategy, there's a lot more certainty there, a lot more confidence, especially if you're within 10 years of retirement. But if you want to get even more conservative than that, there's other things that generate income, such as bonds, such as preferreds, and so on. And again, I can't tell you what those investments are actually going to be worth in 10 years, but I can tell you with pretty good certainty what the income is going to be. So again, that's the thing. If you know you want to use this money for retirement income, then why are people still out there investing for growth? They should be investing for income. In fact, coming up, I want to talk about that more, but I also want to talk about, Sarah, is really the number one mistake that investors and advisors make when trying to create retirement income from their savings.
All right. Well, I'm Sarah Samuels, and I'm here with Dave Scranton. You're listening to the Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels, and I'm here with the host, Dave Scranton, and today we're dispelling some common myths about retirement and why some people believe you need to take more risk if you want to maximize return. And Dave is telling us why that's really not always the case and what our listeners and our viewers out there should invest in to make their retirement more reliable. So, Dave, everything we talked about a few minutes ago, it sounds great, investing in dividends, which are almost guaranteed, so you don't have to worry so much. But it seems like a lot of people don't even know how much incomes or interest or dividends they're actually getting on their portfolio.
Yeah, you touch upon a really good thing there, Sarah, because If I'm in a room, let's say 30 people, and I say, do you know roughly how much you made or lost on your investments last year? Maybe 10 out of the 30 will actually know. But I say, now keep your hand up if you know how much yield, how much interest or dividend yield, how much income the portfolio spun off last year. And 9 out of the 10 hands drop. And the one hand that's up is often somebody who didn't understand the question. So it's ironic that most people would say that, Sarah, you're planning for retirement. Most of my money is here to generate retirement income in a few years. But yet most of those same people don't know how much income it's generating. And that's because of the cancer that's created through our environment. We're taught as financial advisors that's all about total return. And that's why everyone's competing. All advisors are competing against the S&P 500. Can I beat the S&P 500 or maybe some other stock market index on a total return basis? And that's great if you want to retire and spend a chunk of money in a lump sum. Okay, so if you carve off some of your retirement money, Sarah, and you want to spend it in a lump sum, then great, you need to look at total return. Agreed. But if most of that money is there to generate retirement income, you shouldn't be looking at total return. You should be looking at income, how much it pays in interest and dividends, right? Remember that equation. Total return equals income plus growth. TR equals I plus G. You're focusing on the TR when you're your age, Sarah, because you don't care whether you get whether you make money from interest and dividends or growth. But when you get to my age, all of a sudden the I is more important than the TR, right?
Right. Well, especially when you're getting close to retirement, you're thinking about retirement, you have to think about that income. And like you said, Dave, it's a mindset transition where you have to stop thinking about total return and actually think about what's making up that total return.
And most advisors don't even teach their clients to make that transition.
And that's my question. Why do you think this isn't commonplace with most advisors? Is it just the way people were taught in the past from the 80s and 90s where the stock market was great? Why do you think this happens?
Oh, I think I'm not a conspiracy theorist guy, so I don't want to get into that, but I feel like, to answer your question, though, I feel like part of it is because Wall Street in general makes more money when they have you in investments that need to be more actively managed. And generally speaking, the more risk, the more active management's required, right? If you had a nicely laddered portfolio of government bonds that could never default and didn't need any management, you wouldn't want to pay a management fee for that, right? So Wall Street,
especially not a high one that some managers
can't make any money.
Yeah.
So as a result, many advisors, and I would say 8 out of 10 easily, are taught to use a withdrawal strategy to engineer income. Instead of generating interest and dividends to retirees, it's literally to engineer income. And the problem with engineering income is you're withdrawing money and you're hoping it grows back. Withdrawing money and hoping it grows back. And that is the number one cancerous strategy that I've learned over the course of the years that anybody can embark upon, because sometimes it grows back and sometimes it doesn't. So they're trying to engineer it through withdrawals, and they go through all kinds of mathematical analysis to try to say, hey, you got a really good chance of this working out, but there's also a chance it doesn't work out. The only way to feel secure in retirement, I believe, is to live off the interest and dividends and don't touch a dime of principal, because if you're withdrawing money, then yes, you're taking principal and you hope it grows back. And sometimes it does, and sometimes it doesn't.
Well, our next Ask Dave question, it looks like this listener might have one of those advisors you're talking about, Dave, that's relying on this withdrawal strategy. So Troy from Kansas says, my advisor relies on the buckets of money strategy where I spin down each bucket and then replace it with the next bucket of money. Mm-hmm. Is this a good strategy?
Well, Troy, a buckets of money strategy is a little bit of a classier way to spend principal. So instead of just having a whole portfolio and withdrawing 3% or 4% across the board, because that's what most advisors, there's discussion as to whether you can withdraw 4% safely without running out of money, or is it closer to 2.5%, or is it 3.5%? There's discussion. So first of all, there's not a given number that everyone agrees upon. But there's risks taken across the board. And when you're doing it with buckets of money, what your advisor is trying to do is withdraw from the more conservative buckets to let the more volatile buckets sit on the tail end, so that if markets do drop, you're not being forced to withdraw from the more volatile buckets early on. You have time for it to recover. So it's a little bit of a classier withdrawal strategy, but Troy, it's still a withdrawal strategy. It's not as good as generating real income from a portfolio.
Troy, thank you so much for sending in your question via email. And if any of our other listeners or our YouTube viewers out there have a question that you'd like Dave to answer, just send us an email at askdave@retirementincomesource.com. And thank you so much for spending your weekend here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels, and I'm here with Dave Scranton as we're dispelling some common retirement income myths. And Dave is explaining why you don't always have to take more risk in order to maximize your return. So, Dave, we've talked a little bit about this withdrawal method, and to me, it really seems like the chicken or the egg, right? With income, it's the eggs. Your chicken lays eggs. You're eating these eggs every day, and pretty much until you pass on, right? You've got eggs every day. Versus the withdrawal strategy.
As long as you keep the chicken alive, you'll have more eggs.
Right, exactly, right? But with the withdrawal strategy, it kind of seems like that's when you go out and you take care of the chicken and you eat chicken for dinner. But then you have no more chicken, no more eggs, and you're in a pickle.
That's right. No, that's exactly true. And you know, so the problem with this is there's lots of mathematics that surround it, and a lot of advisors use software that's approved by the industry that, you know, frankly, if there were ever a client complaint to the regulatory authorities would probably back up the use of this software and support it. But the reality of it is you never get to 100% certainty, right? So with most advisors, if you get to 85% certainty or 90% certainty of somebody not running out of money, that's a good outcome, okay? Well, yeah, if you had a 90% chance you bought a lotto ticket and you'd win the lottery, that would be pretty cool, right?
Sounds pretty good odds,
great,
right?
But if you had a 90% chance that you wouldn't lose your life savings, but a 10% chance that you did, now it's a different story.
Yeah.
And see, that's the problem. All these things are backed up by this mathematics called Monte Carlo analysis, even Troy's buckets of money strategy, which all often leave a 10 to 15% chance of running out of money, right? But they never talk about this, right? It's like I always talk about my old business partner. You remember Steve, right? When Steve had his hemorrhoid surgery years ago,
right?
And the doctor said, well, you're going to be in a little bit of discomfort, right? So a day later, he's sitting in a bathtub full of ice cubes on the phone yelling, a little discomfort, you know? He was miserable. Well, doctors downplay the misery he's going to be in. And financial advisors oftentimes, sadly, downplay that 10 or 15% chance of failure, right? What can go wrong? So think about it. If I said to you, okay, Sarah, here's what I want you to do. I've got the paperwork set for you to sign over your life savings to me. But before you sign it, I just want to let you know that there's about a 15% chance that you're going to run out of money if you work with me, okay? So go ahead and sign right here. Here's all the paperwork. Go ahead and press hard. There's 3 copies.
I don't know about this plan, Dave. It kind of reminds me of the drug commercials out there where it's like 5 or 10 seconds about the drug and then like 50 seconds of disclaimer and all the horrific things that can happen to you. That's what it sounds like to me.
And that's what the withdrawal strategies do. And, you know, if you start getting close to 15%, I mean, that's about the same percentage as playing Russian roulette with a handgun with 6 holes, right? And taking the bullet, right? 1 out of 6. That's 16%. So when it comes to something big like your life savings, you know, most people, if they really knew the risk they were taking through these withdrawal strategies or even the buckets of money strategy, they wouldn't do it, right? It's kind of like I say, hey, come on my airplane. Come on, we're gonna go fly. Let's say you were in my airplane flying up to the New York Stock Exchange in February. We rang the bell.
I'm so
right?
happy I wasn't on your plane. Teresa told me about that.
Yeah, you get on
the
plane.
Turbulence.
In a turbulence, that's right.
It's horrible.
But let's say before we left, we said, hey, you know, I just want to let you know there's about a 90% chance that we're going to have enough fuel. We're going to be able to land safely.
Nope. I'm only taking 100% chance that we're going to make it there. Or I guess 99.9%.
That's right.
There's always something left to chance.
That's right. So again, I think if our industry taught us as advisors to be 100% honest with people and they realized the risks with these various withdrawal methods, including the buckets of money like Troy's using, that people wouldn't want to do it.
All right, Dave, well, coming up, you're going to have to fulfill your promise and blow some people's minds here, just like Jesus, and tell us how you might be able to get more return for less risk.
That's right. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's always all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels, and I'm here with Dave Scranton as we dispel some common retirement income myths. And Dave, you promised us at the beginning of the show here you were going to blow our minds, just like Jesus did when he rose from the dead. So you are going to have to tell us, Dave, you have to cough it up here. How can people get more return for less risk? The age-old question.
That's right. That's right. Well, it's simple. It's much simpler than what Jesus Christ did by rising from the dead, because it's really just math. But first, let me ask you, if we were to take a survey of our listeners and say, over the long run, which of the following is going to get a greater return on investment for our investors? Is it high dividend value strategies, or is it growth strategies?
It's going to be growth strategies.
It's going to be growth strategies, right? That's what most people believe. That's what we were taught as advisors and so on, right? But the interesting thing is the math says otherwise. So let me explain. Years ago, I looked at something, not too many years ago, because I just 3, and I was looking at the return for the first 20 years of the century on the S&P 500, right? So I projected out how much money $1 million would have turned into if you invested in the S&P 500, the Fortune 500 companies, 20 years later. And if you were taking dividends, it would have grown to 2.2 million. So you would have done a little bit more than double if you took the dividends in cash. If you reinvested the dividends, it would have grown to 3.2.
Even better.
Would have done better than tripling. Well, if you figure out what those internal rates of return are to get $1 million to grow to 2.2 or 3.2, the first is 4%. You would have earned 4% a year average had you taken the dividends in cash, and 6% per year average if you had reinvested the dividends. But I thought, wait a minute, I've been in this business through the first 20 years of the century and way before that, and the dividends on the S&P 500 did not average anywhere near 2% for that time. In fact, they averaged probably 1.3 or 1.4%. So now, Sarah, I want you to think back to math class. Do you remember when your math teacher taught you that? And I know you're a marketing person. Marketing people aren't great at math, but that's okay. Let's work with me here. Do you remember when your math teacher taught you that 4 plus 1.4 equals 6? You remember that?
I must have been absent on that day in class, Dave, because I wasn't great at math, but that number doesn't sound right to me.
Right. So that's why I questioned. I said, how can we get from 4% return to 6% by reinvesting the dividends when dividends didn't average 2%? The math doesn't work, right? So then I had a theory, and my theory was, maybe it's the power of dividends, dollar cost averaging. You see, there's lots of academic articles that are written about how dividends are worth more than growth in the stock market, but they always fall short of explaining why. So I thought about that 20-year period. I thought about some of the big drops in the market, and I thought, okay, if those dividends are getting reinvested, essentially they're dollar cost averaging, which means you're buying more shares when the market's low and fewer shares when the market's high. If you have growth stock with no dividends and the market's down, you're just down. There's no good that becomes of it. But if you have those dividends are buying more shares at a low price, and that's a good thing. That's got to make up the difference. So then I went and created a hypothetical portfolio that paid over a 4% dividend. And I said, okay, what if we just took each month for that 20-year period, which is 240 months, right? And what if I said, okay, let's increase the dividend to get it over 4%, and let's decrease the growth or capital appreciation. So the TR, the total return, is the same, but the I is much greater, and the G, the growth, is much lower. And I said, let's take each month and let's project the math, what would have actually happened in my hypothetical portfolio for the first 20 years of the century. And you know what the return came out to?
What?
It came out to over $8 million, Sarah.
Wow.
Not 2.2, not 3.2, over $8 million, which was an internal rate of return of 11%.
Oof, that's pretty good.
So this is proof that you don't need to take more risk to get more return, because high dividend value strategies generally have less risk than growth strategies.
Yeah.
The math says you can actually take less risk in the stock market and get more return if you know what you're doing. Now, I'm not saying that value is going to do better than growth, but the point is that if value averages 11, growth has got to average, or averages 6, growth has got to average almost double that to outperform, because it doesn't have the dividends. And that's taken a lot of risk to try to get double the return.
Yeah. Well, Dave, I know you're really a smart guy, and I know our listeners and our viewers out there are educated, of course, and they're listening to our show, right? So, of course, we're giving them all the information that they need here. But our next Ask Dave question actually has to do with what I mentioned a few moments ago, that it's not really for the faint of heart, that investing in the stock market to get dividends like Dave's talking about can be difficult if you're just a run-of-the-mill DIY investor. So our next Ask Dave question actually comes from Brian in New York. He says, Dave, I invest in stocks and I consider myself an expert. Do I really need a specialist for investing for dividends?
Well, I want to Brian, let me answer your question throughout the rest of this segment here today. So stay tuned because, it depends. And we'll talk about what it takes and why high dividend value investing might be trickier than growth investing. And then at the end of the segment, you can make a determination for yourself. But, the reality of it, though, is that, again, you can invest in growth-based instruments without a dividend. But in the first 20 years of the century, you would have had to get almost twice the return, take a lot of extra risk, and maybe get twice the return, maybe not, just to match the return of our hypothetical high dividend portfolio. So, Brian, make sure you stay tuned because I want to cover this over the next few minutes.
Yeah. And Brian, thank you so much for emailing us your Ask Dave question. And if anyone out there has a question you would like Dave to answer, just send us an email at askdave@retirementincomesource. That's SOURCE.com. And thank you for spending your weekend here with us on the Retirement Income Source. I'm Sarah Samuels, and I'm here with the host, Dave Scranton, as we dispel some common retirement income myths. And this idea, of course, that you can actually get more return for less risk in the stock market, which Dave has kind of explained how to do that, but he's also explained why it's not just for the average DIY investor or the person that's looking to do a little trading, right?
Yep, and I can't rise from the dead, and neither can anybody listening to this show, but your retirement portfolio might be able to rise from the dead if you feel like you're behind the eight ball. If you have a goal, you have this magic number you want to hit, and you're thinking, gosh, how am I going to get there? You might be surprised that this higher dividend strategy could work if you want to stay in the market. Now, so to answer Brian's question in more detail, Sarah, it's the reason it's a challenge, a bit more of a challenge than growth stocks. And see, everybody doesn't think that. Everyone thinks, gosh, I can invest for high dividend stocks and it's easier than growth companies because I just buy a bunch of utilities and sit back. But here's the thing you have to be careful of, is that higher dividend companies, by definition, are in the mature part of the corporate life cycle, right? They're not startups, they're not Teslas or anything. They're mature companies. So you have to say, are you at the beginning of the mature part of the life cycle or at the end? Because if you're at the end, that's where you could be the next Kmart or the next Woolworth, or the next Sears, where you start to decline, right? And where next thing you know, companies are cutting dividends and stock prices going down, and then they're cutting dividends again. So in the financial professionals, when they're talking about high dividend value strategies, talk about a value stock versus a value trap. A value strategy is something that's typically at the beginning part of the mature part of the corporate life cycle, where it's a good value. The company has hidden value that the market's not seeing, where there's some things that could happen that help the price jump up. Whereas a value trap is something that is cheap, but it's cheap for a reason, because the stock should be cheap. It's probably at the later part of the mature portion of the life cycle. So what I want you to understand, Brian, is that when you're talking about making this differentiation between a value versus a value trap, your research needs to begin where your current research probably leaves off, right? So I know you're good at the financials. You can read cash flow statements, income statements, and balance sheets, and that's all great. I know you can look at charts and maybe do some technical analysis, and that's all great. But to be a true high dividend value-oriented manager, you have to do that, but then you have to really go through an exercise and figure out whether it's a value or value trap. And how most good professionals do that is they talk to people they know in the industry, various contacts that they may have built over the years, and they find out their people's opinions as to why they think it's a good value versus why some others may think it's a value trap. They call the company, they call shareholder services, which most of yourself investors can't even get through to shareholder services. Institutions can, and they ask these questions, and they try to get answers. They try to make sense of those answers. Then maybe they come up with a shorter list of questions, and they come back a second time, and in that second iteration, they then ask more questions. So whereas growth could be very much about momentum and very much about the financials and about the charts, when you come to high dividend value strategies, it's more about the subjective, qualitative components of it.
Yeah. And if you're not like Brian, you do not want to do it yourself and you're looking for an income specialist, you can always check out our website, retirementincomesource.com, to find an income specialist in your area. Coming up, we'll talk about more ways you can help maximize your return and try to minimize your risk as much as possible.
And that's if you want to be even more conservative and not be in the stock market. There are alternatives. Stay with us. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income. And welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with Sarah Samuels. And today, so far, we are talking about all the myths that people have bought into. And frankly, I would guess 4 out of 5 financial advisors have bought into also when it comes to retirement income planning. And in the last segment, I hopefully were able to blow the minds of some of our listeners, Sarah, where we talked about how you may not need to take more risks to get more return if you realize that your goal is to maximize your retirement income. And so far, we talked about how to do it by going from maybe a growth stock strategy to more of a high dividend value strategy. But now I want to talk a little bit more even to some of our more conservative listeners who, may not want to have a lot of money in the stock market at all.
Right. Well, people might argue, Dave, companies in hard times, sometimes they cut dividends, but there are things like bonds and bond-like instruments where you don't have that same risk as much.
Yeah. So, when you have a bond, you have a stated interest payment on the bond, and the only way the company can really default is if they're going to default on their debt, basically a bankruptcy of sorts, So they can't just cut dividends to preserve cash or because they want to acquire more companies. With a bond, they can only really cut if they're just about to default. Same thing is true with preferred stocks. Preferred stocks are a stock, but they pay a higher dividend. They pay a higher yield. And again, same thing is true there. Then you get to the things that are what I call bond-like stocks, right? Things like maybe BDCs or real estate investment trusts, which are stocks, but they have things inside of them, loans or maybe leases, that again, companies inside of those investments would have to default or go bankrupt before these other companies would then cut the dividend, because legally they have to pay out over 90% of the income they receive. So there's lots of ways that you can do it with more certainty than the common stock market. Okay, so for Brian, who is a do-it-yourself investor,
right, our Ask Dave question from
to do that in the
few
market.
Moments ago.
Great. I bet Brian could triple his dividend if he's mirroring the S&P 500. He's probably at a 1.5% dividend yield, something like that. Well, he can easily get that up over 4, but he's got to do all the extra work I mentioned. And of course, the problem with doing that extra work is that most, again, do-it-yourself investors don't have contacts in the industry to ask all those questions about whether it's a value or a value trap, and also don't really shareholder services won't take a call for an individual investor. You've got to be more institutional.
Yeah. And Dave, you mentioned it's more for the conservative listeners, people that maybe don't want any risk at all. So it seems like part of this whole thing is figuring out your risk tolerance, right, and understanding your comfort level with risk.
That's right. That's right. And there's 2 comfort levels. One is a comfort level for what your lump sum is worth. And that's more of an emotional thing, right? If you're getting income, you shouldn't care if your lump sum drops, right? Who cares, as you said earlier, if you go to sell the chicken and chickens sell in the market for less money? Who cares if the chicken's generating the same number of eggs it was before, right? You don't care if it's worth less. But there's an emotional component if you get your statement and the investments are down. So you've got to figure out your pain point emotionally, where you're just not going to be able to enjoy your money anymore. But then there's a risk on your income. And that's what we're talking about here, because there is a risk that common stocks do cut dividends in some cases. You've got to be careful with that. When you get to bonds and preferreds, again, like I said, in bond-like instruments, that risk goes down significantly. Why? Because those companies essentially have to default, essentially have to go bankrupt before they can cut.
Yeah. So it sounds like bonds could be the better move here, but are you ever too young to invest in bonds? Because our next Ask Dave question actually comes from Mark in Utah. He says, I'm about 10 years or so out from retirement, but my advisor says it's too early for me to invest in bonds. Is that true? Age limit, Dave. Have you ever heard that one before?
Well, it's interesting because, again, we have to go back to that question, Mark. Do you want to build a retirement plan based upon what you hope is true or what you know is most likely to be true, right? And I could hear you right through the radio. You're saying, yes, Dave, based upon what I know is likely to be true. And if that's the fact, then you're not too young to invest in bonds because, like I said before, even in a stock, all I know is that dividend payment. That's all I know. And all I know is if I reinvest that dividend, that it's going to grow by the dividend rate. So if I get $1 million with a 4% dividend, then I reinvest that 40 grand. I know that 40 grand is going to grow by 4% a year. Well, ironically, if you want to be even more conservative and be in bonds and bond-like instruments and maybe get a 5% interest payment. Now that on $1 million, that's $50,000 a year, and that $50,000 a year will now grow at 5%, right? So it's going to be even a bigger retirement number. So yeah, you may not have as much lump sum at the end of the day, but by making that transition 10 years out, you're likely to have even more income. So we tried to blow everybody's mind before with given the math with saying, hey, in the stock market, you can actually, in many cases, lower your risk, go from growth to a high dividend value strategy and actually increase your return. Well, guess what? If your goal is to maximize income, Mark, for future retirement, not for lump sum purchase, then guess what? You can lower your risk even a step further. Yes, I know you're 10 years out, but by going from stocks to more bond-like instruments 10 years out, getting even higher income, and therefore being able to project with some security, some level of security, even a higher future rate of income when you actually retire. So again, another place where unfortunately 8 out of 10 advisors, Sarah, just don't really understand. They're going by this old adage, gee, I've got to take more risk for my clients to get more return. And it's not true when you're talking about retirement income.
Right. Yep. Well, Mark, thank you so much again for sending in your question. And if any of our listeners out there have a question that you want us to answer on a future show, all you have to do is email me at askdave@retirementincomesource. That's SOURCE.com. And we appreciate your time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels, and I'm here with Dave Scranton. And today we've had a pretty good show. We've been dispelling all of these common retirement income myths, talking about purpose-based retirement, right? Deciding what your goal is for your money. Are you trying to win the game of life here and retire with as much money as possible? Do you want to buy something? Do you want to leave a legacy? Do you need income? These are all really important questions that people have to ask themselves as they get close to retirement.
Yeah, and think about it this way. Imagine Mark's advisor keeps him in the market for 5 more years until he's 5 years out of retirement and then gradually starts filtering in some bonds. But, imagine now if he's got $1 million today, and we have a repeat of the 2000 through 2010 period, right? Where the market was down even 10 years later, right? The fact that it happened once this century tells us it can what?
Happen again.
It happen again, right?
Absolutely.
So now Mark's $1 million is down to 800,000. Sarah, do you think if he's down 20% on his money, do you really think he's going to want to sell his stocks at a 10% loss at that point?
Absolutely not. I know I wouldn't want to do that, and I think that's why it's so important too, Dave, is to make that transition, of course, and to make sure that your assets are allocated properly, and of course that you're working with an income specialist, someone that can not only get you to but get you through retirement.
And I'm guessing that Mark's advisor is just like 80% of the advisors out there who are great in the accumulation years, don't understand the income years. And he's taking Mark's $1 million and projecting, well, it's going to be worth $2 million by the time Mark retires, and then we'll snap our fingers and we'll switch it over to bonds and get him 4%. So 4% on $2 million, that's $80,000 of income. And Mark's probably feeling pretty good about that. But the reality is that, if it drops, if the market drops and he's at 800,000 and he's in the market at an average dividend of 1.5%, he's only getting 12,000 of income. Well, do you think Mark can retire 10 years from now on 12,000 of income?
So we're looking at a swing, right? 12,000 all the way to potentially $80,000, guessing, right? It's a guessing game.
And I think if Mark's advisor were brutally honest, just like, you remember good old Steve, my ex-business partner here, your ex-leader, right?
Yes.
If his doctor were honest enough to say you'd be in a lot of pain after the hemorrhoid surgery, it might have had a different outcome, right? But I think just like that, Mark's advisor is downplaying the possibility of the markets being down in 10 years and, frankly, the possibility of him getting only 12,000 of income. Yeah. He's focusing on that 80. Well, Sarah, if you can go in bonds, let's say today, and get 5% income, and that 5% income grows at 5% a year because it's reinvested, his income will be over $80,000. It'll be over $80,000.
And it's essentially guaranteed. There's no swing here.
That's right. And I don't have a clue in the bond market what his lump sum is going to be worth 10 years from now, any more than his current advisor has a clue what the lump sum is going to be worth if he stays in the stock market. But here's the reality. Mark doesn't care. Mark wants to maximize his money for income. That's why it's in a 401k. That's why it's in an IRA, right? He doesn't care. But yet Mark's advisor was taught to make crazy assumptions about growth, even though he knows in Mark's heart, Mark wants to build a plan based upon what he knows is likely to be true, not what he hopes is to be true. And that's the problem in our industry. And Sarah, I hope I hope that we're able to clarify this for our listeners right here on today's show.
Yeah, I hope so too. And if you enjoyed the show, you want to listen again or maybe send it to your friends or family, all you have to do is go to retirementincomesourceradio.com, and all of our past episodes are there.
Yes, we'd love it. Please, please, please share our show with your friends and family. Most importantly, thank you for joining us today, and we hope you join us again next week. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.